So here we're going to turn a bit to the international market, and we want to talk about the Saudi oil prices. And this is just looking at the official selling price that was issued. And you can see that there was an increase across the board, Arab extra light, Arab medium, Arab heavy. It's still below what it was in May. May was a bit crazy, but typically this is still a seasonally adjusted all-time high. That's not to take away from what has been done. But when you look at some of the reasons for it, and when you look at the spread, right now, like just to take an example for Asia, right? So Asia is $6.50 above Oman, Dubai, but so $6.50 above Oman, Dubai, but dated Brent is $11 above Oman, Dubai still. So they're still coming in higher, but below dated Brent and still a bit more competitive, where in May, they blew through the number. They were not over $9 above, and dated Brent moved lower to a $5-6 spread versus Oman Dubai, again, kind of trapping some of that crude in storage. So this is still increasing, but still remaining a bit more competitive, and so far it's paying off because people and companies are still holding to and actually increasing a bit their loadings that are scheduled for July. Now, they did cut pricing into the Mediterranean against ICE Brent. Light was dropped by $3, medium by $2, and heavy by $3. So there's still a certain amount that, in terms of trying to compete a bit into that market, U.S. remained flat, and then into Europe or into Northwest Europe increased a bit. But you're still seeing, again, some of that tightness on the heavy side, and it's really looking at that distillate cut. It's to Asia that we continue to see that pressure, but when you think about going into Asia, you're not getting the same type of China and India demand, and a lot of this Asian product is going to be sold into Japan, Singapore, and some of the other nations. And you might think, well, they're still elevated. Why would you increase in July? Because they need that distillate cut. And crack spreads, which we'll talk about in a minute, are so high, it even supports this elevated price, which is why they're able to achieve these moves. Now, when you look at the Russian exports of crude and product, it's still remaining elevated. Russia's ESPO blend oil exports expected to reach an all-time high of 880,000 barrels a day in July. Again, it's just because a lot of that continues to flow into India, into China, but more specifically for ESPO into China, as we've seen those prices come down. Now, Beijing, on the other hand, to try to move things through, as we had discussed the last few weeks, we expected them to increase the refined product exports. They increased the quota to 4.5 million tons. And again, that's just with the new allocation that they're going to try to, again, not only capture that really healthy margin in the diesel market, in the middle distillate market, but also try to balance out some of their underlying storage, because storage remains very elevated in general when you're looking at some of the different flows. And that's why they, again, trying to manage those opportunities. Now, when you start looking at where is a lot of this crude flowing from, a lot of it is coming from Greece. We talked a bit about that on the FSC show. But Greek tankers typically make up about 35% of capacity. Right now, that's up to 55% since the invasion. And again, a lot of tanker companies are headquartered in Greece. There's a lot of unknowns, or let's just say gray areas in the EEZ zones between Turkey, between Cyprus, Greece, Libya, and Egypt in terms of where you can be, who owns what. So you can fall within some of those gray areas. But as we talked about the sanctions that Europe put on, it includes insurance. And the problem is now, okay, well, you have 6 months, so there's no rush to do it at this moment, especially for some of these Greek ships. But what is the damage if they run it? If they can't get insurance because it moved a cargo, instead it gets insurance from the Russian central bank or from the Indian central bank. Well, once it's done with that route, will they be blacklisted because it moved Russian crude, so then they can't get additional work? So some of those fears could even just get rid of some of that and, again, move it lower. And that's going to be an important thing to watch. Now, you can see here that the movement lower. So this is showing what has officially crossed, which is $36 below dated Brent. It's actually closer to 40. And you're seeing how quickly ESPO is catching up, because essentially China said, look, I am not paying above what Urals are clearing at, and you can see that it has quickly run down to that because Russia needs this product to continue to move, and they're going to incentivize those movements, and that's why you're seeing some of this pressure. We have seen a little bit of a pickup of activity coming out of West Africa in terms of purchasing, but it is still very low from the Asian markets. And here's why: because India and China, some of the largest buyers of West African crude, have other options, and again, they're going to that, but is also increasing the miles per ton, increasing the amount of crude on the water and crude in transit. While it's dropping floating, it's still keeping a lot of crude on the water, which we'll talk about in a minute. So Russia has a record volume of crude oil at sea amid the Ukraine war. Russia crude in transit and floating storage remaining at all-time highs. We don't see that changing, just given the timing delay, and again, the miles per ton, which is going to keep that in the market. So when you look at and we made reference to this in segment 1, Agena Nigerian crude blends has a very high distillate cut, and you're seeing the premiums remaining very high for this cut, actually closer to $10 to $13 above dated Brent, because the middle distillate crack is so strong and diesel crack is so strong. You can pay that premium and still make a healthy return, which is why we're seeing a lot of this move into the Mediterranean as well as into the West African markets, because they need that middle distillate cut. Again, Asia has dropped out for the most part, and we don't see that picking back up because it's pricing itself out. China can use ESPO. India can use more Urals and Iranian blends in order to avoid the more expensive. But it doesn't mean that there isn't going to be demand. That demand is just going to shift into the European and U.S. markets. So then when you think about the importance of it, 2 refiners intend to take more July loading volumes of Saudi Arabian crude. So Saudi Arabia is pricing itself, if you will, at when you think about the Mediterranean on the medium side, it's a 30 cent premium to ICE Brent. On Oman Dubai going into Asia, it's at a $6 premium. So given where Agena crude is, where these crudes are, now you kind of get an idea that Saudi Arabia is trying to find that sweet spot to keep some of these cargoes moving as they lose some of those customers out of India and China, but really still stay within a comfortable zone for some of the other buyers out of Asia, mostly being against South Korea, Singapore, Japan, as well as maintaining some of these flows and competing with the Nigerian crudes into Europe, which again drove some of those discounts going into the Mediterranean and into the U.S. And here's just putting it into perspective what those cracks look like. So Singapore low sulfur diesel over Dubai crude is remaining very healthy. And then when you look at ICE gas oil, so China issued the extra fuel quotas, so they'll move some of that product out to try to capture again this healthy spread. And that's something where obviously costs have gone up, crude prices have gone up, but you're still recovering that, which is why you're seeing those moves. But when you start thinking about the emerging markets, when you think about Pakistan, Vietnam, when you think about Indonesia, Malaysia, how much longer can they run ultra low sulfur diesel and LNG, given that the spread between ultra low sulfur diesel and high sulfur fuel oil is the widest it's been in 2 years? Well, at some point, it's just going to be the monetary value they're going to have to go towards and run more high sulfur diesel. So China gasoline stockpiles dropped 14.7 million tons in the week through June 3rd, down 4.7% week on week. Diesel inventories fell 2.9% week on week. Gasoline and stockpiles held by independent refiners remain shrunk by 28 and 29% respectively. And again, that's just because they're trying to push that into the market as they did to get that new quota. They still remain very elevated for this time of year, and they're going to try to, again, balance that perspective as they try to bring these refineries back up and running, get them back in action, and again, trying to balance things out. Now, when you look at Saudi Arabia light OSP to Asia, you can see just where things are. Obviously, it's against that below that May high, but you can see it's still holding firm. Now, India is looking to double its Russian oil imports. So as they double their Russian oil imports, you're going to see some of that come down by just displacing not only Nigeria, Angola, but also some of the Middle Eastern crude. So this is just finding that sweet spot to keep those flows moving. India has bought more than 40 million barrels of Russian oil between late Feb and early May, which comes to about 20% more than flows for all of 2021. To give you an idea on the level of buying, which is going to leave more of that Middle Eastern and West African crude in the market, which is why it's not surprising to see crude oil on the water coming to the 2022 highs. We do believe that it will take out those highs. Obviously, it's not going to get to 2020 levels, but we see that, as you can see, the comps get easier as we get into early August, and we do believe that 2022 cargoes will be above 2020 levels because of the Russia-Ukraine war, because of the more miles per ton, because of these other underlying shifts. And that's also putting more crude oil in transit, which is coming back to the 2022 highs. And we do believe that it will take out this 2020 level as we continue to print new all-time highs, not only seasonally adjusted speaking, but also against 2022 levels. So the higher, the more crude that is in transit, you're seeing that come out of floating storage. So even though floating storage has dipped, it's not that there isn't a record amount of crude. It's just how is it being classified? And as it shows up, we do expect more of this to show up in floating storage, which again, the comps get a bit easier. So as we progress through June, we're going to take out those highs because we did get that dip in 2021. We will take out those highs. Obviously, it'll still be well below 2020 levels, but it'll still be at an elevated component. And a lot of that drop was coming from Asian floating storage because they're pulling in more as they reactivate, as they get more active just in general. That'll drop back down. But when you start looking at those different flows, as the Russian crude shows up, that's going to put more in floating storage and keep us above the 2021 levels. West Africa had a little bit of a drop, but still seasonally adjusted all-time highs. So prices still remain elevated. There's a mixture of what type of crude is being demanded. And again, that is adjusting just how much is moving, but there's still a lot of crude sitting in floating storage in West Africa. So then when we start looking at China's super tankers, it's just cargoes that are targeting China, they have dropped. And it's just when you look at that drop, it typically happens right now. So we do expect this to bump back up, especially as some of those cargoes come through. But they're right now trying to take in as much of that floating storage. And as they start to balance out, that's when you're going to see this pop back up and remain what we think to be pretty close to the seasonal norm. So when you start looking at the overall levels of available crude, there's a significant amount of crude that is available in the market. And as you get these refiners starting to ramp back up, they're still below that average level. But again, we see the state-owned refiners holding at about 75%. And realistically, when you look at Shandong, the teapot's at about 65%, which is why they needed some of that increase in export capacity. U.S. crude exports, gasoline dropped 106,000 barrels a day, still 438,000 above the 5-year. Distillate fell 152,000, fell 28,000 below the 5-year. And some of the things, as we said last week, we expected gasoline to remain either at the 5-year or, above the 5-year, but below the top of the cloud. And we'll show how that was the case. And we expected distillate to fall just below the 5-year, but again, well above the bottom of that cloud. Propylene, the LPG exports fell 319,000 barrels, still 141,000 above the 5-year, where crude oil exports dropped 1.758 million. It's still 2.2 million. It's just going to be the timing of it. And as the timing comes back through, We do expect this to remain at about that 3.5, 3.6 million barrels a day of exports on the 4-week rolling average. Gasoline exports, again, still remaining strong. We do expect it to come down just a bit, but the demand going down into the Latin American market still remains robust, which will keep this elevated. Distillate coming right back to that lower end. We just expect it to stay pretty close to the 5-year average. The margins still remain strong, but there's a lot of demand and that remains in the U.S., which is, again, going to try to balance out in terms of where the flows are going. Ethane, holding to the 2022 highs. We don't see that adjusting as ethane remains strong. Here's your drop in crude oil exports, but it's more important to look at it on that 4-week rolling average. And it's holding at that 3.521 million, which, again, as we were saying, that 3.5 million is a very comfortable place for this to live in. So then when we look at propane, propylene exports, you could see that it had a drop, but it's seasonally speaking, there's normally a drop here. It's still at the well above the 5-year, and we just expect it to be above the 5-year, but more likely even above the top end of that cloud. Dubai, the swaps here, it's at $11.10. So again, you're still seeing a lot of dated Brent remaining at a significant premium, which is supporting, again, as coming back to what we were talking about, the activities that we've seen out of Saudi Arabia. Now, Singapore refiner margins, you can see that it's still record highs or just off record highs, but it's still going to support a significant amount of activity, especially when you're considering the amount that was going to be done on the middle distillate front. And just to put that in perspective, here's the hydrocracking refinery margin, which is still at over $35. And again, still covering the elevated price of LNG, the elevated price of crude. There's still a lot of reasons why this is going to remain strong. So then when you start looking at the flows, we've had a little bit of an increase in Nigeria, same with Angola. The Libya still remains a bit pinned. We don't see that going above 700,000 barrels at this point. Above that, right now it's at 633,000 barrels a day. We don't see it going above 700 this month, just because there's continuing to have issues in terms of politics as well as equipment. But Russia, we expect to hold close to that 4.47, 4.45. BP sold some Fortes at $3.70 above dated Brent. It was last week at $3.25. So again, starting to see some of those premiums. That remains the case. It's anywhere between 280 and 380 at this point. And then when you look at Angola and crude, it's selling faster in July versus June, but it's still much slower than what is normal. And by normal, we can go into last year or pre-COVID. And it's really because China's buying has increased, but it's been gradual. And again, it's coming back to them purchasing from the Russian markets. There's 10 to 11 cargoes of Angolan crude left for July loading out of the 37 that were scheduled. China's buying of Angolan supplies remains lower than its typical rate, but again, that's not surprising based on everything that we've said. It's a relatively normal pace of sales with the next monthly trading cycle due in about 8 days. Angola's differentials to dated Brent have strengthened to at least $1 versus what it was in June. So again, still something normal. 2 to 3 July cargoes for Congo are searching for buyers out of the 6 scheduled, which is fairly normal for this time, a little bit slower. But again, that comes down to China not buying. And then Nigeria is continuing to see those premiums with Agena at about $13 a premium, with Agbambi offered at $4.30, more than dated Brent. But that's down from $5.75 at the end of May. So again, it depends on the grade. What is the distillate cut? So some Nigerian crudes are coming down. As we were saying, they start higher and fall slowly. So again, as you're trying to find this pace, so we do expect some discounts to come out of Nigeria, while some continue to remain elevated depending on that spread. ARA had a small drop. You can see it's still fairly comfortable versus where we were previously. As we said in the segment 1, we already covered the current data for last week, because remember the EIA show, the U.S. data came out on Thursday. So we were able to pull down Singapore and Europe for refined products. So again, there's nothing to say until next week. So here, when we look at what happened in Fujairah, light distillates had a big build, while middle distillate and heavy distillate had some small draws, which is in line with what we were saying, where light distillate is going to continue to see builds, just given the amount of volume as middle distillate cuts increase. You're going to inherently throw off gasoline, but gasoline demand is shrinking. So when we look at total stocks in Fujairah was 12.193 million, which is again above the 20 million mark, which is the first time since last November. Stocks were higher, and again, it's just total stocks in general were up 515,000 barrels. Light distillate rose 1.1 million. They were so the highest level for over a year. And again, that's just because there's that slowdown in gasoline. There was some strengthening. There's been some bids that have gone out of Malaysia as just because there is some turnarounds, and there's some additional purchasing from Indonesia and Pakistan. But as inflation hits some of these areas, even though they're sniffing around trying to figure out pricing, what we don't expect to see a huge increase in that. While middle distillate, on the other hand, had a drop of 115,000 barrels. Gas oil market, again, record high level for cracks, continuing to boost the export incentives for gas oil producers with excess barrels. The strength in the gas oil market has been outpacing that of crude oil in recent days, pushing cracks of the distillate to fresh highs, which again is going to incentivize more running as these remain low. And then heavy resid fell 470,000 barrels. The bunker market, the prices were a bit elevated. Delivery premiums are still at historically high levels, and sellers are looking to take an opportunity of this. But that we are seeing a marked shift down in container ships, which again is going to put a bit more of an overhang in that. When you look at time spreads, they've softened a touch, but they're still $2.52. So still at those highs, which again is going to support where current Brent prices are at the moment. Then when you look at floating storage here, you can see that there was a drop in the North Sea as some of that, again, will be pulled onshore. Some of that was sold into the market as we had some pretty competitive pricing. Middle East still remaining elevated for floating storage. We should see this come back down, but they may also want to put a little bit of a buffer in, just given where some of the demand is, where some of those activities are. We do have some additional refining capacity coming online, so they may want to ensure that there's some available, and again, build a little bit of a buffer in the system. So maybe they'll, because they did increase their levels for Asia, reduce it for the Mediterranean. So it's just going to be a matter of, I think, holding these levels, which are actually a bit higher, but they appear to be comfortable with it. With Europe, floating storage, remaining at seasonally adjusted lows, but fairly in line with where they were in 2019 and 2021. Which we don't see adjusting. So that's what we have for you today. There's not too much. If you have any questions, you can find us in the comment section or obviously on Twitter. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.